How does our next guest feel? He sees some underlying employment risks, flagging drops in two lesser-watched numbers, the participation rate today and the open jobs to population ratio, and says if those are factored in, the unemployment rate would have actually climbed. Michael Gapen is chief U.S. economist at Morgan Stanley, and Phil Orlando is chief equity strategist at Federated Hermes. So, Michael, lay it out for us. You still see an economy that's on the margin weakening?
Yeah, I do think the jobs report today says the economy is cooling. I agree with the summary just brought forward that the economy's not rolling over and the bottom of the labor market isn't falling out. So I think today's number is consistent with cooling but not rolling over. But as we noted, there are some softness underneath these headline numbers. The participation rate did tick lower. And I think you could argue that 95,000 downward revision to the prior 2 months gives a hint of weakness. But again, these are the things we would expect in general if labor demand is softening and the hiring rate is slowing. So on net, a good report overall for at least the near-term outlook for the economy. And I do agree that it means the Fed's likely to be patient and continue to evaluate how risks are building on both sides of its mandate.
Phil, if you'll sit tight for a second, I want to just talk about, we had on the screen there, Michael, 4.7%. You think that's what the unemployment rate would have been if the labor force hadn't shrank? Is it shrank or shrunk? And Deutsche had some interesting data the other day where they said, immigration has gone from huge numbers every month, people who are frankly coming into the workforce, it has screeched to a halt. What is the net impact all this is having on the economy and on inflation?
Well, cyclically, it means certainly a slower growth economy, fewer consuming households. But I do think that there's an important factor that could explain some of the things we're seeing today. With immigration controls and stories about deportations, I do think you have to wonder about, is there a chilling effect in participation rates where some undocumented workers decide to step out of the workforce? If that's the case, that could help explain some of the participation rate decline. And if that's true, it may be a participation rate that's stable at lower levels. In other words, that 4.2 unemployment rate is not a false signal. It is a tight labor market. And you saw average hourly earnings rise 4/10. So maybe this is just month-to-month volatility, but a million more people than normal, than last month anyway, flowed from employment to out of the labor force. Normally, if this is a layoff story, you think they'd go from employed to unemployed. But no, there was a large flow out of employment into not in the workforce. And so, again, I do think immigration overall means the unemployment rate will stay low and the labor market will be tight even as the economy cools.
Right.
That's why we don't have the Fed easing until 2026, because it'll see a lot more inflation first than it will see unemployment.
Quick last one. I mean, as we get some of these really odd happenings, like the one you just mentioned, million people just coming, say they're no longer looking for work. I mean, do you trust the quality of the data here? Are you worried that there's any data collection issues as they narrow the CPI basket and things like that under some staffing problems?
So far, no. I mean, I think the signal from the data is as good as it's been. But, as you know, that if we're worried, we just start taking 2 and 3 month averages, right? So we need an accumulation of data to tell an accurate story. I do believe in the data that we're seeing. It can be volatile month to month, but I trust the signal.
All right, so Phil, take us home here. And it sounds like you actually kind of agree with Mike in the sense that this is an economy that's not at risk of overheating. So you think the Fed should be cutting rates. Is that right?
Yeah, I agree with a lot of what Michael said. The jobs numbers, non-farm payroll number was better than expected. But our number, for example, was only 77,000. So we were delighted to see the downward revision of 95,000 the 2 prior months. The household survey lost 700,000 jobs. The ISM numbers this week were both weaker than expected. So we see an economy that is slowing down. Now, when the Fed looks at, its dual mandate, the labor market, a little soft, what's going on with inflation? We've been monitoring, the CPI and the PCE data for the last 5 or 6 months. That seems to be trending down. They're sitting here at 4-year lows at the moment. So when the FOMC meets, on the 18th, and this is an SEP meeting, they're going to be adjusting their summary of economic projections. How are they going to reflect, those sets of data, slowing economy, inflation that seems to be, sort of grinding lower, In our view, when we put all that together, we think the Fed could cut twice at the back part of the year, maybe September, maybe December, based upon how the data plays out between now and then.
And their own